So, talk us through your kind of research process a little bit here. We all go about finding things in different ways, and I guess one of the most valuable things I find about talking to different people is partly what they think are interesting stocks, but partly how they go about looking up information and finding stuff and what they're looking for in kind of stocks. So, yeah, tell us a bit about your kind of research progress. You said it's sort of top down ish, macro driven.
Yeah.
What sorts of things do you look for and look at?
Well, yeah. So I guess there's multiple ways to, if I'm purely if I'm purely searching for stocks, I will probably start just by going on Seeking Alpha, for example. If it says this is obviously much more efficient for US stocks, and quite frankly, I've never found something that works quite as well in the UK. But it allows you to search by different metrics. So price to earnings to growth ratio is a pretty easy one to kind of kick things off. And you can set your parameters, and the traditionally a stock with a peg ratio under 1 was deemed undervalued. It doesn't quite work in that way these days. I think you have to compare it against long-term averages and sector averages. But I will start with just scrolling through a really, really long list of stocks where the peg ratio falls within the parameters, which is I normally set quite low because that's kind of gives you a margin of safety, doesn't it? If you're looking at stocks with price earnings to growth ratios over under 0.8, then in theory the peg ratio from the start is suggesting they're undervalued significantly versus your typical traditional average, and that would be a great place for me to start. Of course, I think it's I know we're going to come on to Pinterest soon. Peg ratios can be distorted, and any ratio can be distorted. So there's I can sit there for hours just looking through stocks and stocks and stocks. When I find one that genuinely the data is not distorted, and there's a potential real reason for them being, or for them to be considered, then I'll throw them into a watch list. And then, but behind all that, there's macroeconomic considerations. At this moment in time, and I mentioned this earlier, I think the Nasdaq, at least when I last checked, was about 4 percentage points off its high from February. S&P 500, I think, is pretty similar, 3-4% away from its highs. This all is happening in an environment whereby the US effective average tariff rate has gone from something like 2.5% 4 months ago to, I think in May, I think it was about 17.8%, an average effective tariff. So we're talking about quite a hot market in an environment which is becoming increasingly hard to do business in. And there's an awful lot of kind of, uncertainty because these developments are going on, these negotiations are going on. I think the global market can see what the best case scenario is, and it's possibly what the UK has, a baseline tariff of 10%. So when you factor in the fact that we've moved from 2.5% to 10%, I'm not sure we should, the market as a whole should be where it is today. And this kind of colours my perspective. So when I'm looking for stocks, I'm very much avoiding at this moment in time companies with super high PEs, price to earnings ratios, ones where the growth story is very possible, and I know the market might be very keen on it. But if there's something that tips that growth story into reverse, then that's not something I want to be part of. Great example, I think. I don't know if anybody really follows my work, or has kind of kept up to date with stocks I've been buying over the years. One stock I loved in late 2023 was AppLovin. It's a company that provides software to help app developers and publishers monetize their product, and it kind of essentially brings adverts into kind of game. Originally, at least, it kind of connected advertising with gaming applications. The company has gone from strength to strength, brought in some AI related products. I think the year I bought it, it was looking at earnings per share of $1. This year, projected earnings per share is $8.58. But the shares are up 1,000% since then. It's trading on about 45 times forward earnings. The peg ratio is around 1. That might collectively sound quite enticing for a lot of people. But in this current market, that's not something I want to be involved with, because I think that's the first, that's going to be the first part of the market, along with potentially the Teslas and the Palantirs that are going to fall when things change.
Let's talk a bit more about peg ratio for the moment. It's been a big kind of part of what we've discussed so far. I like peg ratios too, by the way,
Cool.
but I'm interested
Nice.
in kind of why you like them. I'll tell you why I like them in a moment, but you go first. Why is that a metric that you like particularly?
Why do I like it? I think maybe it's because I spent too long. These are phases. I went through a period of investing in stocks that I thought were good value because they traded at 4, 5, 5, 6, 7 times earnings. But in reality, they were staying still. They were mature companies, let's say like your Legal and Generals of the world. That might be a decent investment because it offers a very large dividend yield. But at the same time, if you want to see share price appreciation, that's not the place to go, or likely the place to go, because it's not adjusted with that peg ratio. Sorry, that price to earnings ratio. It's reflected the fact the company just might not be growing anymore, especially when you factor in the dividends. And I think to broadly obtain an idea of what fair value is anyway, you need to be looking at the price to earnings ratio adjusted for growth, adjusted for dividends, adjusted for net cash and net debt. I think those are kind of broadly fundamentals of how you ascertain whether something's at fair value or not. So that it's a ratio which is quite easy to quantify. It's quite easy to adjust for things like dividends or net cash. So that's kind of why I've used it. And I know other discounted cash flow models and things like this other people have used. That was very popular in the past. This is potentially a simpler way as well to at least you can screen a hell of a lot of stocks very quickly using the peg ratio, because that's easy enough to do. Not so much of a DCF.
Yeah, your reason is very similar to mine. I mean, here's the reason I like it. It's because PE ratios go funny on cyclical companies, and they go funny at the top and they go funny at the bottom, basically.
Yes.
So you said things at low multiples aren't always bargains. That's right. Your example's things that aren't really growing. My bigger worry is things that are going to go backwards because they're at the top of a cycle, basically.
Of course, yeah.
And equally, when they're down the bottom of the cycle, they look like they're at quite high multiples of earnings. But those earnings are going to go up quite a lot as things sort of swing back a little bit, whether it's, I don't know, oil prices recover or interest rates come down or whatever it is that's going to push these things higher. So actually things at massive multiples aren't really necessarily overvalued, and things at low multiples aren't necessarily cheap, because they're highly cyclical things, and the market's actually smart enough to know that in a lot of cases. Yeah. They think it's fine to buy this thing at a multiple of 32 because its earnings are going to triple when oil prices go higher or something. And the peg ratio adjusts for that quite well, because it factors in that short-term growth assumption, which is, it can be a big number for even quite a big company, but it's plausible because that's what happens in cyclicality. So, yeah, you were thinking of kind of lack of growth and making things look cheaper than they are. I feel the same thing. I basically did this with Forterra at my own kind of cost, nicely at the top of the market, trading at nearly no times earnings, no debt, no nothing, no just make bricks, basically. And then we had a massive downturn in brick demand, and all of a sudden, those earnings went backwards. That PE ratio went up quite a lot. Nothing had really happened with the business. There are loads more examples, and that's why I like peg ratios as well, by the way. Sounds like a sort of similar reason to yours, to be honest. So it sounds like you do a lot through screening here. One thing you mentioned was that peg ratios, you're right, can be distorted. I agree with that. How do you try and figure out when they are distorted? Is it by kind of just checking against averages, or something else going on here?
So your peg ratio is obviously developed, or you make a peg ratio using the earnings projections for the forward years. So I guess for example, one of the best ways to look at this is if you literally just go through the earnings projections, because sometimes, and this is maybe a more detailed explanation than maybe you're looking for, but say if you have 10 analysts forecasting for 2025, and then 10 for 2026, 5 for 2027, then you've got 1 for 2028. What you can have, and I've seen many stocks like this, is you have a they might be forecasting 12% growth for the first 3 years, and then that final year's growth is 40% because it's distorted by that singular data point at the top. And that's why you can't take the data at face value. I think that's it's really important, for everyone to at least go in and websites like Seeking Alpha make it super. I'm not working for Seeking Alpha, but it sounds like it. But websites like Seeking Alpha make it really easy because you can just you can go in, look at the earnings expectations year by year. Doesn't break it down by which analyst says which, but you've got the data there. And if it starts to look a bit like it's being skewed by singular data points, then it makes sense to kind of detract one of those numbers.
At the very high level, your process feels to me like a kind of Aswath Damodaran type process, albeit when you get into the specifics, it's a bit different. So Damodaran's big thing is that you can't just read it all off from the numbers, and you can't just read it all off from a story either, basically. Numbers themselves can be, as we've been saying, sort of distorting in various ways, and stories are fine, but unless they terminate in some sort of number, they don't really make for anything in kind of investing terms. So the one without the other doesn't really work, basically. And I like the idea that it's not as straightforward as just screening through to find the kind of magic number. I went through a phase of thinking the meaning of investing can be found in some company's accounts somewhere. If I can just work out whether this number is between this and this, or bigger than this, or going up, or going down, or going wherever, then I will know whether this thing is undervalued. And it just doesn't work that way. Do you recognize that as a kind of characterization of the process you're offering here?
Yeah, no, absolutely. Maybe from my own PhD, maybe I call that a mixed methods background or mixed methods research approach. I was never overly good with the methodology section of things, but no, absolutely. And I think that's really important because I think don't get me wrong. I appreciate there are models out there which do quite well, whereby it's entirely data based. Because if you were to potentially buy 20 stocks, all of them had to be US listed with a market cap between, let's say, 5 billion, 25 billion, or 5 billion, or whatever. It can be as big as you want. So you at least get rid of kind of the smaller companies down the end, and it had to have a PEG ratio between or lower than 0.8. I suppose the likelihood is, I would assume that portfolio could outperform over the long run. But of course, you'd have to factor in other things like profitability ratios. And I find that interesting. It's something I've learned recently as well, actually, because I follow lots of portfolios. And I'm very fortunate to do so. One is by Stephen Kress. It's another alpha portfolio. I think it's called Alpha Picks. Performed extraordinarily well for a period of time when the market was moving in the right direction. But as soon as we moved into a period of volatility, whereby things mattered more than just the metrics. So, the taco trade, Trump always chickens out, that's not factored into the metrics. Likewise, the volatility of the deep, at least it feels like a long time ago now, when DeepSeek's R1 all of a sudden became this amazing AI platform, that wasn't factored into the model. So, you'd essentially continually get recommended stocks that were great on paper. They had great, profitability ratios, great growth ratios. The momentum might be really strong because momentum is also a really important part of investing. But I wouldn't invest in momentum today because the volatility is so unbelievable in the last 4 or 5 months. I guess we should expect this from, in a Trump administration, but I think that's really important.